the main misconception about risk is that it is volatility. And so because of that, the response should be to get out when the market is high and get in when the market is low. And I think I've spent a lot of time talking about why that's not a good plan. Very few people have ever done it correctly. And the other reason why it's not a good plan is because the most important thing for investors to do, us, you, all of our clients, is to be invested. That's why they call us investors. And when I go to Europe and they find out I'm in this business, they say, oh, what do you trade? I said, we don't trade. Trading to me is a short-time activity based on guessing what markets are going to do next week, next month, next year. We're investors. We buy and we hold things that we think will be profitable, and we hold them as long as we still believe the thesis until something better comes along. Because economies and companies have an underlying positive secular trend. The most important thing is to ride that trend. After that comes the wisdom of trying to improve on the trend through asset selection, company selection, active management, involvement with companies, and finding niche strategies. But I think that, believing that volatility is risk, as I was taught in grad school back in the 60s, would deter people from owning as much in long-term assets as they should. And I'm against it. The S&P has been up 10.5% a year for the last 90 years on average. If you invested $1 in 30, I think you'd have 8,000 today. So I think that's enough reason to be a long-term investor.